Hello, everyone. Tony here. Last week, US equity markets surged into the back end of the week as fears over President Trump's tariffs and the Federal Reserve's independence subsided. President Trump hinted at reducing tariffs on China, sparking optimism despite China's initial denial. The US also made strides towards trade deals with several countries, and the hope is if they are concluded that they can be used as a template for trade deals with other countries. Meanwhile, Fed Governor Waller suggested potential interest rate cuts from the Fed if the economy weakens. Now, this contradicts or is in contrast to comments made by Fed Chair Powell just a week earlier, who did sound cautious about the prospect of Fed interest rate cuts. Now, while consumer and business survey data continues to dive, the hard data has shown resilience, and that trend is likely to persist for another month or two until the effects of the Liberation Day tariffs become evident, potentially around June or July. If President Trump's tariffs are reduced before then the weaker hard data will be looked through, which would allow the US economy and stock markets to muddle through until the end of the year. However, if those tariffs remain high, then there will be certainly a grave risk that the US economy heads towards recession and that those US equity markets, which we're about to take a look at, head back and retest those lows from April. Now, looking ahead, this week, we see major earnings reports from Amazon, Apple, Microsoft, and Meta. Additionally, we get the Fed's preferred measure of inflation, the core PCE price index, as well as the non-farm payrolls report for April. Let's take a look at the charts of the S&P 500 and the NASDAQ to see where they are as they start the new week. Okay, so what we saw, or I guess probably the best starting point, is where we were this time last week. And we were thinking that this move lower was potentially a wave 5 in an Elliott wave sense of a 5-wave decline. Here's your wave 1, wave 2, wave 3. Potentially this was a wave 4, and we thought this could be a wave 5 unfolding. But we did say if the NASDAQ was to get above this high from April the 9th, then it would sort of raise some doubts around that interpretation. As you can see, we've made a new high above there. However, the one thing which also concerns me is that we've traded above this wave 1 or wave A low. Now, in an Elliott wave sense, we're prepared to allow a little bit of overlap. There shouldn't, in theory, be any, but most times there is. But we certainly want to see the NASDAQ extending higher in the early part of this week. So what I will say at this point of time, we are under review this bearish wave count, which we had this time last week, but it's not, that negates some of the short-term downside risks, but it doesn't negate the medium-term downside risks. And those risks remain in place while the NASDAQ remains below the 200-day moving average, which is this orange line here, coming in around 20,200. So I'd be prepared to allow just a little bit further upside and then potentially another wave lower. But I certainly wouldn't want to see the NASDAQ trade above this level here. And if it did, we would have to start to consider this as being a 3-wave A, B, C correction. And it would signal that potentially the correction is complete and that the uptrend looks set to resume potentially into year end. Now, for the S&P 500, what we can see is the overlap hasn't been quite as significant above this wave 1 or wave A low. So it has broken above the April 9 high, but the overlap has been at this point of time very brief. So we still have potentially this being a wave 4 and then a wave 5 low, which was our count, as I mentioned this time last week. Now, if the S&P 500 were to get above this 200-day moving average, which comes around 57.50, then without doubt we have to move to a more cautious bias. But while it remains, a more neutral bias, but while it remains below, I guess, this 200-day moving average, then I want to allow for it to potentially do a sort of push up for a wave 4 and then a wave 5 lower. So at the moment, what we could say is there has been some developments since this time last week, which questions our short-term bearish bias. However, we still see some risks around a medium-term decline. And as I mentioned in the presentation earlier, I think a lot of it is really going to depend on whether these tariffs continue to be rolled back and thereby the US economy averts a recession. and averts a test of these lows. If we do get a bigger winding back than what we've seen so far, what has potentially been alluded, then I'm more open to the idea that this has completed a correction and we could muddle through into year end. Thank you for listening and have a good week ahead.